Welcome to part 2 of our FinCEN webinars. Part 2 is getting into some more detail on reporting, filing, and some of the penalties. Part 1, the video link went out with the initial invite. So if you want to reference that email to get the link, I will also be sending out this recording tomorrow when I get it edited, and part 1 will be in that email too. We have CE credit approved for Alabama, Louisiana, Pennsylvania, Tennessee. We have CLE credit approved for Alabama, Louisiana, Mississippi, and Pennsylvania. Pennsylvania agents and attorney partners will receive the instructions to submit for their credit. We have 2 poll questions today. It'll be pretty easy. And we might have time to take questions part of the way through, but please submit your questions as they come up. We will get to them when Vince is able to take a break. If you have any questions, any comments, feel free to submit them in the chat box or the questions box. But other than that, Vince, thanks for being our expert here. Take it away.
Great. Thank you, Drew. And welcome to everybody. As Drew said, this is part 2 of our FinCEN residential real estate rule presentation. In part 1, we went over many of the kind of background of the rule, explaining what the rule, where the rule really came from, what it's replacing, the geographic targeting orders, etc. We introduced a number of concepts, and we saved for this part 2 more of a look at what type of information is being actually collected and transmitted to FinCEN in the form of the report. Like Drew said, we will be taking questions, and these questions don't have to just concern the material in the second part. I'm happy to take questions relating to the rule in general. For those of you who have been staying on top of this topic, this past week has been really quite a lot of developments. Before I start, I should really mention that FinCEN just released, and I'll provide links to this. They just released a revised frequently asked questions. It seems to be the first major update since August of 2024, and they added over 100 questions and answers to their frequently asked questions, and they pretty much left. There's only, I think I counted, there were only about 3 or 4 frequently asked questions that they didn't either modify or change or augment in some way. So lots of new materials. Some of the questions and answers are a bit surprising. We'll kind of talk about some of that as we go through this. But anyway, that's the background. This just happened the day before Valentine's Day. So there's lots of new stuff coming. Kind of surprising that they did this so close to the effective date of the rule itself, but there you go. That is FinCEN, apparently. So the real estate report. This is based on the initial estimates of how long it would take to fill out these real estate reports and to gather the information that is necessary for them. FinCEN had estimated about 4 hours and 20 minutes per response. I think we're about to see whether that estimate is conservative or not enough. There have been a number of new entrants to the marketplace in terms of service providers, companies that are offering to make this task a little simpler. And I think one thing you'll find is that this real estate report will either be very simple in the majority of cases, and you will likely have the more, there will be transactions that are substantially more complicated. But for your most plain vanilla type of entities where you have 1 or 2 controlling people, this filing requirement probably won't take you 4 hours. It'll probably take you significantly less than that. But that's all remains to be seen. So the real estate report is divided into parts. I believe we distributed, along with the registration, to this seminar, a copy of the real estate report itself. It is now available on FinCEN's website, so you can take a look at it yourself. But it's divided into 5 different parts. The first part is information that concerns the reporting person. That's really all of us here that we're trying to, that's why we're on this conference call right now, because we are potential reporting persons, and certain information about us ourselves has to be reported as part of this real estate report. Part 2 is devoted to property information. This is not a lot of information, as you'll see. They don't really care about that much detail. They just really want you to identify what the property is. Part 3 is all about transferee information. So that's the buyer's information. That's going to by far be the biggest, most complex, most intricate part of the real estate reporting form. It is on the transferee side, after all, where you're reporting the beneficial ownership information. So that's important. Part 4 is about transferor information. That's the information about the party that is conveying to that transferee entity. And unsurprisingly, the amount of information reported about the transferor is much, much less than the information that's reported about the transferee, because whether the rule applies or not really has nothing to do with the transferor. It's just an incidental fact. And then part 5, you have payment information. For the most part, this again should not be a huge voluminous part of the form itself. There are transactions where there could be quite a bit to report if there are many, many different forms of payment that has to be made. So, information to report about the reporting person. And one thing to keep in mind is that implicit in the rule, and actually explicit in the rule, is the fact that a reporting person has to be someone who is engaged in the business of providing settlement services. All right. In that way, it's a little bit different from the 1099-S cascade, where you actually could have situations where the transferee itself would make the report. With the rule, if the reporting doesn't end up falling on an actual person engaged in the business of real estate settlement services, they're not a reporting person. So if no one's involved in the cascade, the transaction itself is just not reported. So that's the first thing to understand about the reporting person. The reporting person must report their full legal name. All right, and when we talk about the reporting person, we're really talking about a person, not necessarily a natural person, but most often this is going to be a fictitious person. It's going to be a title agency, or it's going to be a settlement agency. And the human being that's handling the file is not who they're referring to. They're referring to ABC Title or XYZ Settlement. That's the reporting person. So you're reporting their full legal name and the category of reporting person. And what they mean by that is they mean where on this reporting cascade that person ends up finding themselves in. Are they the settlement agent? Are they the one that created the settlement statement? Are they the one that recorded the deed? Are they the one that underwrote an owner's title insurance policy, etc.? Also need to be reporting is the street address of the principal place of business of that reporting person. All that's pretty simple. Okay, so going on to transferee entities, transferees, right? We're going to talk about transferee entities, and we're going to talk about transferee trusts, which are the 2 types of transferees that the rule is targeting. So first off, we're reporting some topmost information, which is the full legal name of the transferee entity, any trade name or doing business as name. We're going to be reporting the complete current address of the transferee entity's principal place of business. And if that transferee entity doesn't have a principal place of business inside the United States, then essentially you're going to be reporting the place of business that essentially is the primary location of that entity within the United States. And whenever I say in the United States, it should be understood to mean we're talking about states, we're talking about territories like Guam, Virgin Islands, we're talking about Indian lands, talking about Puerto Rico. So anything within the United States in that more fulsome global sense. And then you're going to be reporting the unique identifying number. Now, it's apparent that Treasury, what they really want is they'd like a tax ID number. Primarily, they'd like that tax ID number, that IRS tax identification number. But if there is, if the transferee entity does not have one, then they would accept, a registration number. If it's a foreign entity, they would accept a foreign tax ID number. So in order of preference, they would like a U.S. tax ID number, foreign tax ID number, and if neither of those are available, then a foreign registration number. They want a unique number that identifies that entity. Now, that's pretty simple. Where it gets a little bit more complicated and where the transferees really differ from transferors is that in addition to that topmost information, you also have to report information about the beneficial owners of the transferee entity. And this is a subject that really, it's been the subject of some confusion because one of the things the rule does, which is a good thing because it provides something familiar to look to, but it's also confusing in that the rule directly incorporates the definition of beneficial owner from the Corporate Transparency Act. So for those of us who went ahead and filed beneficial ownership information about our entities last year when the CTA still required that, we had to get familiar with the notion of a beneficial owner. And that notion was that a beneficial owner was someone who owns or controls at least 25% of the ownership interests of the entity, or someone that exercises substantial control over that entity. And while it's relatively straightforward to understand what people own or control 25% of the ownership of the entity, it's perhaps less obvious what it means to exercise substantial control over the entity without regard to ownership interest. Right? So FinCEN had previously had to issue guidance when the corporate transparency first came out, explaining what they meant by that substantial control. And what they mean is people that are presidents, chief financial officers, the general counsel, the chief executive officer, the chief operating officer, and really anyone else that would perform a similar role or have similar authority to those I just mentioned, those would all be imputed to have and considered to have substantial control over the entity. And so they would be a variety of beneficial owner that would have to be reported. Now that's an important thing because the beneficial owners have to report some pretty sensitive information. They have to report their full legal name, their date of birth, their complete current residential street address, their citizenship, so if they're United States citizens or French citizens or what have you. They're reporting their unique ID number, which again, Treasury would ideally like that to be a U.S. tax ID number. But if that's not available, a foreign tax ID number, and if that's not available, a registration number from the appropriate foreign governmental jurisdiction. Now, one thing that came out recently in the frequently asked questions that I think is kind of significant is that even though the rule borrows the definition of beneficial owner from the Corporate Transparency Act, they are not at this time allowing you to report a FinCEN identification number in lieu of this personal information. For those of us who went ahead and did those BLI reports a year or two ago, we know that for people that were likely going to have to continue to be reported on those forms, FinCEN had created a special identification number that someone could go and apply for, and they would submit their information one time, and then in future filings, instead of providing this detailed information, this sensitive information over and over again, they could just say, here's my FinCEN identification number, and then that would suffice for reporting their beneficial ownership information. Surprisingly, FinCEN is not going that route with the real estate rule at this time. Maybe that's something that they will change down the road, but for now, that abbreviated form of reporting is not going to be available. So that's too bad. We were hoping that that wouldn't be the case. Now, the other type of transferee that is impacted by the rule is a transferee trust. And so the information that we have to report for a transferee trust includes the full legal name, such as the full title of the agreement which establishes the transferee trust, the date on which the trust instrument was executed, again, the tax ID number, and whether the transferee trust is revocable or not. Just kind of a binary yes, no, revocable or not input. Also, for each transferee trust, we must report for each trustee their full legal name, their trade name or doing business as name if they have one, their complete current street address, which would be the trustee's principal place of business inside the United States. And if their principal place of business is not in the United States, then their primary location inside the United States. We would have to report their tax ID number. And the rule just makes sure that they say explicitly that for purposes of this section, an individual trustee of the transferee trust is considered to be a beneficial owner of the trust. For each beneficial owner of the trust, and this is an area where the rules are slightly different for transferee trust as opposed to transferee entities. For the most part, it's the same information. You're reporting their full legal name, their date of birth, complete current residential street address, their citizenship, a unique identifying number, and this is where it's a little different, the category of beneficial owner. So basically, you're indicating whether or not this is an owner, is a beneficiary, or whether they are a trustee. Remember, we just learned that being a trustee is one variety of beneficial owner. Now, whether you are talking about a transferee entity or a transferee trust, both of these types of transferees can have signing individuals, and in fact will have signing individuals. The signing individual is someone who ends up signing anything in connection with this reportable transfer. For each signing individual, you're reporting their full legal name, their date of birth, their residential street address, their tax ID, the capacity in which the individual is authorized to act as the signing individual, for example, president or managing member or even authorized person, and whether the signing individual is acting in that capacity as an agent, employee, partner, and if so, the name of that individual's employer, principal, or partnership. So, individual transferors. The information that's required for transferors, like I mentioned earlier, it's much less than that which is required for beneficial owners. For individual transferors, you are reporting their full legal name, their date of birth, their complete current residential street address, their tax IDs. If an entity is the transferor, you are providing the full legal name, the trade name, or the doing business as name, if any. You're again supplying their street address, that is the entity's principal place of business inside the United States. And if that entity doesn't have a principal place of business in the United States, if their entity's principal place of business isn't in the United States, then you're reporting what would be their primary business location in the United States. and their tax ID. If the transferor is a trust, you're providing the legal name of the trust, such as the full title of the agreement which establishes the trust. Excuse me. The date the trust instrument was executed, the tax ID number, and for each individual of the trust, for each individual who's a trustee of the trust, you're providing their full legal name, their residential street address, and their tax ID. For each legal entity that is a trustee of the trust, you're providing its full legal name, its trade name, again, its principal place of business in the U.S., and if that isn't the case, then the primary U.S. location of that business. And their tax ID. Now, regarding information to report concerning the property. For each residential real property that is the subject of reportable transfer, the reporting person shall report the street address, their legal description, such as, for example, section, block, and lot, and the date of the closing. Some people have asked, does the legal description have to be a meets and bounds description? No, it doesn't have to be a meets and bounds description. And as a matter of fact, FinCEN has basically said they would rather you not provide like a meets and bounds description. They would just as soon prefer that street address and the section, block, and lot. That's adequate for their purposes.
If anyone's been holding on to a question, now would be the time to put it into the question box. See, we have a hand raised here. Henrietta, I think you put your hand up. If you have a question, just put that in the question box. Click the question icon or the yeah. Or if you have any other issues, just shoot me an email. First question is, where do we find the new real estate report on the BSA site?
So actually, I'm going to jump back to this slide at the end, oops. Oh, you know what I need to, how do I get back in there? Bear with me one second here. Here we go, useful links. That topmost link there will take you to the FinCEN rule webpage, and they have all those resources. They are now available. It's basically fincen.gov/RRE.
I'll be including a PDF version of Vincent's presentation today, along with the video links. And Vince, does it make sense to isolate those links on that page and just include them in the body of the email?
Sure.
Cool. Okay. Yeah, I'll do that.
Most of these links too are already going to be on our memos. We distributed a memo, I think, at the end of last week, and another one earlier this week that has these links as well.
Great. Okay. Next question is, what documents do we need to obtain to prove citizenship, birth certificates, passports?
So one of the things that you will see re-emphasized over and over in the rule and now in these voluminous questions and answers document that FinCEN has published is that FinCEN repeatedly says that the reporting person can rely on representations from the parties to the transaction, as long as you don't have reason to doubt the truthfulness of it. So unless you're actually required to like get ID, right, a specific form of ID in the closing of the transaction, that's not part of the record keeping of the rule. The only things that you actually need to keep in terms of records for compliance with the rule itself is a copy of any designation agreement, we'll talk about that shortly, and the certification from the buyer, from the transferee, as to who the beneficial owners are. So the answer to the question is that I don't think I can really tell you that there's a specific document. I think you kind of have to use a little bit of a reasonableness standard. If you know that the person is giving you completely fictitious information, then obviously you can't rely on that information. But the information collection forms that you're going to be using to get this information from the parties should have places for them to provide that information to you. And like I said, the rule and the guidance specifies that you can reasonably rely on that information provided to you from others, so long as you don't have reason to doubt it.
Okay. Next question is, on transactions where attorneys are appointed as authorized signatories of a corporation or LLC, do we need to collect and report the attorney's information, including social security number, on the information collection form? And how do we enter that information on the CTR form on the BSA site? If you need me to repeat any part of that question, just let me know.
So the reporting person information, I'm sorry, the signing individual. So in that case, what you have there is you have another signing individual, right? That attorney is a signing individual. So you're reporting their name, their date of birth, their tax ID, and their residential street address, and the capacity in which they are authorized to be that signer. So that information, right, is in the rule itself. They would be considered to be a signing individual. They might also be a beneficial owner for other reasons, but it sounds like in that situation, they are at least the signing individual.
Great. The next question is, in defining a reportable transfer, would a deed conveying property interest from an individual to his/her single member LLC be considered a reportable transfer?
Yes. Yes. Now that would be a different answer if it was a trust, right? There's a specific exemption for a non-consideration transfer from a settlor to their own trust. But there is no such exemption for an LLC, for an entity.
Great. Does FinCEN require state of incorporation for filing LLC?
No, and as a matter of fact, I mean, you might be able to impute some of that information because of the form of the tax ID number that you give them, I guess. But actually, FinCEN specifically makes clear that the place and jurisdiction of organization of the transferee has nothing to do with whether or not it's reportable or not. And by way of that, they don't. That is not one of the data points that they're collecting.
Great. Next question is, if an individual is transferring title to their own LLC and recording a dollar deed, is that a reportable transaction?
I'm sorry. They're transferring it to their own LLC, and what was the second part of that question?
And recording a dollar deed.
A dollar deed. Okay, well, all right. So I guess from a dollar deed, that probably means a no consider. I mean, it can mean different things, I guess. And like for instance, in New York, all of our deeds will say either $1 or $100 or some nominal consideration amount, and that could mean it's an arm's length sale, or it could mean that it's a gift deed. So that in itself doesn't really say anything. But for the rule, it really doesn't matter whether it's for $1 million or for no dollars. Doesn't impact whether or not it is reportable. The only real place that comes into play is whether or not the exception for transfers into your own trust would apply. And in that case, that exception for the trust is only when the property is transferred for no consideration. But in that fact pattern, where it's being transferred into an LLC, whether or not it's a dollar or $1 million doesn't matter, or $0. It's reportable.
Great. Here's a potentially fun one. What are some of the schemes you anticipate fraudulent buyers will attempt to use to get around this reporting?
Well, that's a good question. That's a good question. And actually, I'd like to take that maybe in more detail afterwards. Well, I guess let me talk a little bit about it. So one of the surprising things that I think you'll see from these frequently asked questions is FinCEN's answer to whether or not a property is considered residential real property under the rule. Residential real property under the rule includes property which is improved by a 1 to 4 family residence, but it also includes property that is vacant where the transferee intends to build 1 to 4 family residences. Surprisingly, FinCEN in their answers doesn't really point to objective criteria to see whether or not that property is residential. They don't say, well, if the vacant land is residentially zoned, then it's residential, or if it's part of a subdivision or something like that. They actually are looking at the intent of the transferee, and that's how they assess whether or not the property meets that definition. So if you have vacant, and one of the examples they give is an example of a developer that's buying a big piece of undeveloped land, and the question, one of the forms of the question was, the investor is buying the land. It's going to eventually be turned into one-family houses, a development of one-family houses, but the investor himself is not planning on building those houses. That's going to be done by a future investor that the property is sold to later. Somewhat surprisingly, FinCEN comes out and basically says, well, that's not residential real property. Even though there's an intent out there that it'll eventually be residential real property, the actual purchaser, the transferee himself, herself, itself, is not intending that they are not intending to build that property, so therefore it's not residential real property. Now, does my cynical side say, oh, that's going to be an area where they can exploit to try to get around the rule? Who knows? But it was an irresistible thing for me to notice as I was reading the rule. And I just imagine that some people are going to try to take advantage of the whole reasonable reliance standard. And we'll really have to see how it shakes out. But the important thing to know is that it can't be something that's obviously false, right? If you know that this person is buying a property and has a house on it, they might intend to use it as a mail order business. I don't know, but that doesn't mean it's not residential real property. Drew, I think I do want to just jump through the last of these slides, and then I'm happy to take as many more questions as people have, but I do want to make sure for people that are looking to get credit on this that I'm actually hitting all these subjects so that they can compliantly claim that credit. So if it's okay, I'm just going to jump right into these last slides that we have here and talk about the information to report when it comes to payments. So the reporting person shall report the following information concerning each payment other than a payment dispersed from an escrow or trust account held by a transferee entity or transferee trust that is made on or by or on behalf of the transferee entity or transferee trust. Now I'm going to come back and explain what that means in a second, but let me just go through the basics here. You're reporting the amount of the payment. You're reporting the method by which the payment was made. If the payment was paid from an account at a financial institution, the name of the financial institution, and the name of the payor on any wire, check, or other type of payment if the payor is not a transferee entity or transferee trust. The reporting person shall report the total consideration paid or to be paid by the transferee entity or transferee trust regarding the reportable transfer, as well as the total consideration paid or to be paid by all transferees regarding the reportable transfer. Now, the beginning of this section where it talks about money paid from an escrow account. What that is actually referring to is this following situation. You have ABC LLC, and they sell Blackacre. And the money from that sale is put into an escrow account held by another company. That other company then, subsequent to that transaction, essentially assigns that escrow deposit for the benefit of the seller of Blackacre in their acquisition of Whiteacre. That is the type of transaction they're saying would not be one of the payments that need to be reported. It's a very specific scenario, but that's what that's referring to, as clunky as that sounds. Another item that's being reported on the real estate report is whether or not hard money is involved. So the reporting person is reporting whether the reportable transfer involved credit extended by a person that is not a financial institution with an obligation to maintain an anti-money laundering program and an obligation to report suspicious transactions under this chapter. Now remember, the applicability of the rule doesn't turn on whether or not there's hard money or not. Like I mentioned earlier, it can apply just as forcefully to a gift as it could be to a sale. However, one of the data points that needs to be reported is whether or not such hard money lenders are involved. So that's something to keep in mind. Now, filing procedures. The way this real estate report is actually submitted is that you go to the FinCEN website. If you don't have some other outside filing service to do it, there's a form, there's a PDF form that you can click through. It's somewhat similar to the currency transaction report that some of us have had experience with under the geographic targeting orders. And you'll notice that PDF is kind of an intelligent PDF, and it's adaptable. It can grow and shrink in accordance with how many beneficial owners you have to report and things like that. The report has to be filed, and I'm sure I went over this in the first part, but the report needs to be filed, excuse me, within the later of 30 days from the date of the transfer, or the last day of the calendar month which follows the calendar month in which that date of transfer occurs. I've had some people ask, well, what about when it's recorded? Does that have anything to do with it? And no, it doesn't have anything to do with it. When they talk about date of closing, when they talk about date of transfer, they're talking about the date of that deed, or whatever instrument is that transfers ownership. Now, the designation agreement. I mentioned earlier that the designation agreement is one of those items that needs to be kept as part of our records. Now, the designation agreement, we actually supplied with our memo earlier this week a model designation agreement that can be used. It has all the requirements of the designation agreement. The designation agreement has to be in writing. It has to include the date of the agreement, the name and address of the transferor, the name and address of the transferee entity or transferee trust, the information about the transferred residential property. That is the street address, the section, block, and lot, that property identification information, the name and address of the person designated through the agreement as the person who will be the reporting person, and the names and addresses of all other parties to this agreement. Somewhat implicit in this is that the designation agreement really has to be put forth by the company, or it has to, let me put it this way. The party that can designate who is going to be the new filing person has to be the party that would otherwise be that default filing person. We talked previously when we reviewed the reporting person cascade about how there are these several roles that FinCEN has set out. the top role of which being the settlement agent, and then the person that drafts the settlement statement, and then the person who records the deed, and then the person that underwrites the title policy, et cetera, et cetera. The designation can only go downward, right? So if there is a settlement agent involved in the transfer, then that settlement agent is the party that can designate the title agent, the person who's recording the deed. That settlement agent is the one that can designate the title agent as the reporting person. Someone below the title agent or someone even between those two in the reporting person cascade doesn't have the authority to make that designation. They can still join the designation agreement, so you could actually have a designation agreement where everyone doing all the different functions in the transfer all agree that such and so is that filing person. But the indispensable parties are the person who would be that default reporting person and the person who's going to be the designated reporting person. So that's something to understand about the designation. Let's see. Record keeping requirements. Now, in the rule itself, it doesn't actually specify terms of years where you're keeping these documents. The only thing the rule itself says is that you need to keep that certification of beneficial ownership from the transferee, and you need to keep a copy of any designation agreement of which you are a party to as part of your records. You have to look at the Bank Secrecy Act in general and the regulations for FinCEN in general to understand that actually that means that you need to hold on to it for 5 years. Both of those pieces of documentation need to be held for 5 years. Penalties. So when FinCEN initially published the rule, similarly to how they approached the record keeping requirements, they did not specify exact penalties for non-compliance with the rule. And they fell back on the general overall authority of FinCEN to impose fines and penalties. Now, that kind of was changed when they came out with these frequently asked questions, and they actually came out with some specific information. And you'll see that negligent violations of the rule could result in a penalty as of 2025. And keep in mind, the reason why they say as of 2025 is because they actually get to increase these maximum penalties in accordance with inflation as the years go by. So as of now, they could assess you up to $1,430 for each violation, and an additional civil money penalty of up to $111,308 for a pattern of negligent activity. Willful violations could result in a civil penalty of not greater than the amount involved in the transaction, not to exceed $286,184, or $71,545. Criminal penalties for willful violations could result in a term of imprisonment of not more than 5 years, or a criminal fine of not more than $250,000, or both. So I'm assuming they wouldn't be putting these penalties on someone who simply made a good faith mistake. But if you are part of an organization that just willfully flaunts this rule, FinCEN does appear to have some teeth they could come after you for. So this is the last slide that I'll talk to before we go into questions. But these are some great links. I've heard a lot of people have lots of questions about the form itself or the portal. All that information is available at FinCEN's main website for the rule, which is at fincen.gov/RRE. The frequently asked questions that I've been referencing repeatedly today are found on that webpage. You can go to that directly by going to fincen.gov/RRE-FAQS. Another question I've gotten all the time is, how can I tell if a lender is AML SAR regulated? How can I tell if a lender has to have an anti-money laundering campaign or suspicious activity reporting requirement? One of the best ways of objectively confirming this, I've found, is to see if they're listed, to see if the bank is listed on the FDIC insured bank website. And there you go. That's the link. If you want to go to that, you can look up, you know, I think we all know that Chase Manhattan Bank and Citibank, these are all AML, SAR regulated lenders. But if you have a lender and you're not sure, you can go ahead and look them up there. Credit unions have a similar website where you can take a look there. Barring that, FinCEN also has advised that you can reach out directly to the lender. And just like they say in connection with information that you get from the transferor and transferee, you can rely on information that you are provided by third parties, and that includes lenders. And if you inquire with the lender and you say, you know, are you, does your bank have to have, or does your firm have to have anti-money laundering, SAR, suspicious activity reporting obligations under the FinCEN rule? If they can answer you one way or the other clearly, you can keep that as your due diligence. And FinCEN has basically said, as long as you don't have reason to doubt that, you can rely on that. Drew, I think I could take some more questions now. I think we're now at the 50-minute mark, 51-minute mark.
Sure. We have a few questions since last time. There's been a lot of articles and stories in relation to the need for affordable housing. If an investor or developer is purchasing a commercial building like an office building, shopping mall, etc., with the intent to convert that to residential housing, would that be a reportable transaction?
It's an interesting question, but from reading the, you know, my answer might have been different maybe a month or two ago. But from looking at these frequently asked questions, I kind of think that that would really turn on what the intent was of the buyer. You know, if it was demonstrable that the buyer, that was their plan, and they plan to go ahead and build housing on a site, and you know, even if that site currently has a dilapidated warehouse, but they're intending on knocking it down and building a subdivision of single-family homes, I think that's probably a reportable transfer. And that's something I feel like I kind of learned new in the last several days.
Great. Next question is, what if the buyer is doing a 1031 exchange of a residential rental property? Is that transaction affected by FinCEN?
So the transfer to the qualified intermediary would be exempt. There is an exemption for 1031 exchanges, but it only operates in one direction.
Okay. Next question.
And you will actually also see that, you know, along with the designation agreement that we circulated with our memo, one of the forms that we created in-house was a transfer questionnaire where we walk you through with questions and answers, prompting you to document and to answer certain questions that by the end of the form, you basically realize whether or not you have a reportable transfer. And that question about the 1031 exchanges is part of that transfer questionnaire. So if you want to kind of do some practice, you can go ahead and look at this transfer questionnaire and just, you know, put your mind in the place of a couple of your recent transactions, and you can kind of figure it out on yourself, on your own, whether or not you had a reportable transfer.
Next question is, if bank checks were issued not by the entity buying, but from the buying entity's purchasers, from the sale of the buyer's previous home to the seller of the home that the buying entity is purchasing, how do we get the account information for these bank checks that were issued from a sale transaction not pertaining to our transaction?
I'm not sure if I'm going to ask you to read that again, or maybe have that question submitted afterwards, because it sounds like it's got some moving parts to it.
We can try to. I can read it one more time, but if you want to do the due diligence to read it in text, just let me know. So if bank checks were issued not by the entity buying, but from the buying entity's purchasers from the sale of the buyer's previous home to the seller of that home. Oops, sorry. I had an email come through and cover it up. Sorry. If the bank checks were issued not by the entity buying, but from the buying entity's purchasers from the sale of the buyer's previous home to the seller of the home that the buying entity is purchasing, how do we get the account information for these bank checks that were issued from a sale transaction not pertaining to our transaction?
So that question, I think, has kind of shades of two different sub-questions within it. On one hand, would that type of a payment qualify as an escrow payment paid on the behalf of the transferring entity? Then the other part of that question seems to sound in whether or not a bank check, what information you would need to provide about a bank check. And I actually had that specific question posed to me yesterday. Unfortunately, that was not answered affirmatively by FinCEN in this latest round of frequently asked questions. I mean, so I don't think we have an actual answer to that question. To my mind, though, it doesn't really make a lot of sense that you would be reporting. You know, when you go and get a bank check, right? That account number that's on the bank check is not the account number of the actual payor, right? I mean, well, the payor is the bank, but the person who has those funds, that's not the account number that's actually getting displayed there. And I think until we get better information from FinCEN about those particular types of transactions, I think we have to fall back on the information that is provided to us from the parties. It's really their job to be reporting to us information about these forms of consideration. So unfortunately, I do not have an answer for that at the moment. But Drew, if we could make a note of that one, I will see if I can't shake down some more specific information about that when I talk to my colleagues. I'm actually doing another one of these presentations next week, so I can do a little powwowing with some people at the New York Bar Association. Possibly.
Yeah, certainly. Next question is, do you need to get a certificate from the bank or lender if they have AML/SAR?
You could. You don't have to. I think, if you're able to find them on the FDIC list or the National Credit Union insured list, I think that's pretty good proof that you're dealing with an AML/SAR regulated lender. But if that's not available and you can instead get that information in the form of a certification from the lender, that sounds pretty good to me.
Okay. Next question is, how will this affect a purchaser entity that is a nonprofit, purchases cash, rehabs with financing through NJHMFA or a lending institution such as Fulton Bank?
So, I mean, some of that seems pretty transaction specific, but in general, FinCEN has talked a little bit about not-for-profits. And one thing that they do mention about not-for-profits is that they don't view anyone that owns a non-for-profit as someone who doesn't have substantial control. So basically, if you're an owner in a non-for-profit, you're most likely going to be considered, even if you don't have 25% ownership, you likely do have substantial control over the operations of the business. So you would probably be a beneficial owner. The other aspect of where I think, your not-for-profits, where this could get interesting, is in some jurisdictions. New York is an example that's just at the tip of my tongue. In some jurisdictions, in order for some types of not-for-profit organizations to do their transfers, they either need to get approval from the Attorney General or from a court order. One of the exemptions from having to report are transfers that are overseen or directed by a court. So in answer to that question, for not-for-profits, this rule could impact which direction the transferees and transfers attorneys go when it comes to these transfers. Maybe they might think to themselves, you know what, if I have a choice between getting this approval from the Attorney General or getting the approval from a court, maybe I should just go ahead and get it from the court, because if I got it from the court, then I won't have to report, I won't have to worry about this FinCEN real estate report, because it will be a transfer pursuant to a court order. I'm sure there are other ways this is going to impact not-for-profits, but those are two that kind of jump right at it.
Great. Next question is, if a principal or beneficial owner is making a capital contribution of residential lots, to what is considered a disregarded entity LLC, must it be reported?
So whether or not your LLC has a tax ID or not, or whether it has a tax ID but it's disregarded as a taxpayer, really it's not germane to whether or not it's reportable or not. Also, the form of consideration or the reason for that transfer is also not important. So whether or not it's a capital contribution or it's a sale or it's a gift or whatever, doesn't really have any effect on whether or not it's a reportable transfer or not. Basically, a transfer to an LLC is almost always going to be reportable, unless it's like a publicly traded LLC, or it's a transfer because of one of those exempt types of transfers, like a transfer that resulted from death, or a transfer because of a will, or a transfer because of a divorce. It's most likely going to be a reportable transfer.
Great. Next question. The last question for now that we have. Wait. 2 questions left. Does the buyer attorney need to designate the title agent to file with FinCEN where the buyer attorney prepares a closing statement to be used for settlement?
So, first of all, that's a very good question, because it shows that the person asking the question has done some research, because the settlement agent and the settlement statement has a specific meaning in the rule, and that is the statements of receipts and disbursements made and prepared for the transferee. So, so that person in that scenario would be the designated, that would be the default reporting person. They do not have to designate the title agent to be the reporting person. But in that instance, if they wanted the title agent to be the reporting person and they wanted to be relieved of their own obligation to make that report, they would need to enter into a designation agreement. And that's one of the special things that a designation agreement does in the context of the rule. A designation agreement can only be between persons that would find themselves on the reporting person cascade. It can't be with someone outside of the cascade. You can delegate to someone outside the cascade, but it's not going to be regarded as a designation agreement. And the importance of that is that a designation agreement not only shifts the task of doing the reporting, it shifts the responsibility.
Okay. Last question. Public agencies, municipalities, and nonprofits buy and sell. Are they exempt?
As buyers, they are exempt, yes. As transfers, what they are doesn't really have any. If you're talking about a governmental entity as a transferor, it doesn't really have any importance, unless it's like a court that's doing it, or it has some other. There's something else about the transferor being a certain type of transferor that makes it fit one of the transfer exemptions. It doesn't matter. But as a transferee entity, or transferee trust, governmental entities are exempted.
Great. Do you have any final thoughts, Vince, before I wrap this up here?
No, I mean, other than everyone that's part of this call, please feel free to contact me if you have any questions, or if there's something that you feel that hasn't been answered very specifically, please let me know. While I might not have the answer immediately, I fortunately am talking to a lot of people who are also interfacing with FinCEN. So even if I don't have the answer, I can at least try to get you the answer.
Sure. And then I guess this is most likely going to be ongoing from some of the conversations that you and I have had, where there's still going to be a need for maybe additional webinars with information and things like that. This isn't just March 1st and then we're out kind of thing.
Right. And knowing the way, things are, you never know. Someone said there, I'm sure there will be people that, on April 29 are looking at this for the first time. And the first reports are going to be due at the end of April. So.
Sure. And then Vince, would a phone number or email best be the way to get in touch with you? What would be your preferred?
I'm an email guy, so I'm in vdanzi at esecuritytitle.com is a great way to get in touch with me. Welcome to use my phone number too.
We can just do the email address. That's okay. Yeah. I'll include Vince's email in the wrap up, or in the follow-up email that will have both this webinar recording, part 1, the links that you're seeing here on the page, Vince's email, and I'll follow up separately with the Pennsylvania agents and attorney partners for their CE documentation. That's it. Vince, thank you. Thanks for being our expert here. Thanks to all of our agents and attorney partners for hanging out with us, learning something new. And like Vince said, this will be ongoing. You can go to our FinCEN webpage, esecuritytitle.com/FinCEN. We'll be adding resources as they get created. But hope you all have a nice rest of your week.
Thank you, Drew, and thank you everybody for joining us today.